You're not broke because you spend too much. You're broke because the mathematical foundation of the American middle class is undergoing a fundamental, controlled collapse. Right now, in real time, we are rapidly transitioning from an ownership society to a permanent renter class. And the worst part? Most people will never realize exactly how the system is operating behind the scenes to keep them locked out. Welcome to USA Rift. I'm your host, and today we're embarking on an unflinching explainer of this tectonic shift in American wealth. Before we jump into the raw data, do me a favor, subscribe to the channel, like this explainer, and comment below on what you thought. Your engagement is literally what keeps this channel going. And if you want to take it a step further and support our deep dives, consider becoming a channel member. So, let's get into it. Because what we are about to uncover today is not just some passing economic trend or a temporary market glitch. It is a structural shift in the cost of capital, an environment of unprecedented asset inflation, and the slow, quiet erasure of a foundational American dream.
Are we witnessing the death of private property in America? It's a heavy, uncomfortable question, isn't it? Picture the traditional single-family home. For generations, it was the ultimate symbol of autonomy. But today, it's as if that home is locked securely behind a heavy steel gate, while massive economic forces funnel the broader population toward corporate-owned apartment complexes. When you peel back the macroeconomic data, the true numbers driving the market, not just the fleeting, sensational headlines, you start to realize that the traditional wealth-building engine is systematically shutting down for a vast portion of the population. The dream hasn't disappeared, but it has been priced into the stratosphere. In this explainer, we're going to examine the very real mechanics neutralizing this dream, turning it from a guaranteed middle-class milestone into an exclusive, heavily fortified privilege.
Section 1. The death of ownership. The collapse of the 30% rule.
For decades, personal finance was governed by one incredibly simple golden rule. You should not spend more than 30% of your gross income on housing. It was the absolute bedrock of financial stability. But as we survey the modern economic landscape, that rule has been completely, totally neutralized. And the reason that math is so spectacularly broken today is represented by one single glaring number, 7.14. Let's put that into perspective. Historically, a typical home in the United States cost around 5 times the yearly median household income. If we rewind to the 1990s, that price-to-income ratio averaged just 3.2. Even during the massive, infamous housing bubble of 2006, a bubble that literally almost broke the global economy, this ratio only briefly peaked just above 7. But today, right now, a typical U.S. home costs a staggering 7.14 times the median annual household income. We are sitting well above the levels of the most notorious housing bubble in history. But here's the terrifying difference. This time it's not built on bad subprime lending or NUJA loans. It is built on a structural, mathematical scarcity that has completely paralyzed the middle class.
And that brings us to the next towering barrier, $126,700. That is the massive, 6-figure annual income now required just to afford a standard, median-priced home of $412,500. And I want to be really specific here because the details matter. This calculation isn't based on luxury terms. It assumes a standard 31% debt-to-income ratio, a basic 30-year fixed-rate mortgage, and a typical 3.5% down payment. Just 3 years prior, in 2021, that required income was roughly $79,300. Think about that for a second. In the span of just 36 months, the income floor to enter the American dream skyrocketed by over $47,000. In more than half of all U.S. metropolitan areas, you now need a 6-figure income just to secure a basic, entry-level roof over your head. Wages absolutely did not go up by $47,000 in 3 years.
So what does this look like in practice? We are seeing a historic, entirely broken disconnect between home prices, mortgage interest rates, and soaring monthly payments. The median single-family sales price has soared upward to that record $412,500. But the real killer is the monthly mortgage payment. It has spiked violently. With interest rates hovering in the high 6% range, the monthly mortgage payment on a median-priced home rose to roughly $2,570. When you adjust for inflation, this record-breaking payment is about 40% higher than it was in 1990. Your paycheck hits your bank account, and immediately, an unprecedented, outsized chunk of it is devoured by the sheer cost of capital. You aren't just buying a house anymore, you are buying highly expensive debt.
The immediate impact of this is brutal. It's like a massive brick wall dividing the population. According to the American Community Survey, out of nearly 46 million renter households currently trapped on one side of that wall, only 6 million can meet that new $126,700 income benchmark to pass through the gate. This means roughly 8 million renter households who had incomes perfectly suited to buy a home back in 2021, those earning between $79,300 and $126,700, have been entirely erased from the playing field. They've been boxed out. The system is actively filtering out an entire demographic of traditional prime home-buying age citizens. It's keeping them in a cycle of permanent occupancy, where they go to work every day simply to build equity for someone else.
Section 2. The Golden Handcuffs, the trap of the 3% mortgage. Now, you might be wondering, why aren't there more homes for sale to balance this out? Well, this brings us to a hidden mechanism freezing the entire market from the inside out. It's the realization of how this system traps even those who already own homes. When you break down all the outstanding mortgages in the United States, a shocking 51.5% are locked in at an interest rate of 4% or lower. Even more astonishing, a full 20% of all mortgages sit below 3%. These are the golden handcuffs. If a typical homeowner with one of these ultra-low rates wanted to sell their house and buy a new medium-priced home in today's high-rate market, they would see their monthly payment increase by nearly $1,000. $1,000 a month just to trade sideways, literally paying $1,000 a month just for the privilege of moving. So what happens? They simply don't move. They stay put. They don't take new job offers in different cities, they don't downsize when their kids move out, and they don't upgrade when they have a growing family. The natural turnover of real estate completely, totally halts. Let's look at the exact behavioral economics of this trap. The Federal Housing Finance Agency found that for every single percentage point that current market rates exceed a homeowner's original locked-in rate, the probability of them selling their home drops by 18.1%. This specific lock-in effect prevented an estimated 1.33 million home sales between the second quarter of 2022 and the end of 2023. That is over 1 million homes completely starved from the market. And here is the brutal paradox of the situation. Even though high mortgage rates have absolutely crushed buyer demand, this artificial restriction of supply has driven home prices up by an additional 5.7%. Think about how crazy that is. The lack of supply is completely overpowering the lack of demand.
Section 3. The institutional scapegoat. Wall Street versus reality.
When you have a crisis of this magnitude, politicians on all sides scramble for a villain. They need a bad guy, and the chosen scapegoat is almost universally the same: the institutional investor. We've seen lawmakers from across the political spectrum, from Donald Trump to Elizabeth Warren and Bernie Sanders, propose bans or severe restrictions on Wall Street buying up single-family homes. But in this explainer, we deal with reality and impartial data. Contrast that deeply political narrative with this tiny number, 0.55%. Large institutional investors, meaning entities that own 1,000 or more homes, actually own just 0.55% of the national single-family housing stock. That is roughly 450,000 homes out of a massive national stock of 82 million. Furthermore, data from John Burns' research shows that institutional investors accounted for less than 2% of all home purchases in 2025. Now, regardless of how you feel about them, mathematically speaking, when market participants own less than 1% of a market, they simply lack the power to substantially dictate terms or single-handedly cause a nationwide housing crisis.
So if they aren't the root cause, what are these institutions actually doing behind the scenes? Well, they don't create the shortage. They capitalize on it. Specifically, they capitalize on local zoning failures. They target markets where local governments have failed to approve enough new housing to meet population growth. Now, it is true they compete directly with regular buyers. Academic models show that for every property they purchase, they crowd out 0.22 homes from the owner occupancy pool. However, their operational efficiencies also mean that total rental supply actually expands by 0.5 homes for every institutional purchase. While their cash advantages do permanently convert some entry-level stock into rentals in highly concentrated zip codes, they are just a symptom of a much larger disease. The disease is the systemic, decades-long failure to build enough single-family homes in America.
Section 4. Renting versus buying, the math of the new normal.
So, if home ownership is structurally dead for a massive segment of the population, we have to ask a deeply critical question. Can renting, combined with disciplined investing in the stock market, actually build comparable wealth? If we look strictly at historical baseline returns, the argument for stocks seems really compelling. From 1990 through early 2024, the S&P 500 returned an average of 8.7% annually. Residential real estate, on the other hand, returned about 4.2%. Let's look at the granular math in a high-cost market like Seattle. the out-of-pocket costs for a $1.5 million home, including a mortgage at today's rates, steep property taxes, and a mandatory 1% annual maintenance budget, can easily exceed $10,000 every single month. Renting a comparable home might cost just $5,800. The prominent financial theory is that if you take that massive $4,200 monthly difference, that delta, and aggressively invest it into the S&P 500, you will inevitably come out way ahead.
But here's where the system truly reveals its hidden architecture. Because the real world doesn't operate in a vacuum. To expose the unseen power of leverage and tax subsidies, we have to look at a full 10-year outlook. When you buy a house, you are using a bank's money to multiply your returns. A 3% appreciation on a $400,000 home yields a much higher absolute return on your initial $20,000 down payment than a 10% return on $20,000 sitting in the stock market. You get all the appreciation on the entire asset, not just your down payment. Add in the forced savings through monthly principal paydown and the massive, unparalleled $500,000 capital gains tax exclusion for primary residences. This is literally the most powerful tax advantage available to the middle class. So what's the bottom line? In a meticulous 10-year outlook model, the homeowner ends up with a net after-tax wealth of $1,523,000, while the hyper-disciplined renter investor sits at $1,101,000. Homeownership still drastically outperforms the rent and invest strategy, because the entire U.S. tax code and financial system is engineered from the ground up to subsidize it.
Section 5. The Great Inequality Transfer, a Hereditary Privilege.
When you scale this narrative up, the societal consequences become deeply alarming. We are looking at a fundamental shift in American culture. Housing is no longer merely a utility for shelter. It has become a leveraged financial asset that dictates the trajectory of an entire bloodline. Look closely at the human cost embedded in the data. As of 2025, the median age of a first-time homebuyer has climbed to 40 years old. In the early 1990s, the typical age was roughly 30. That is an entire decade of delayed entry. Because wealth compounds over time, this delay effectively robs an entire generation of 10 crucial wealth compounding years. And this isn't just theory. Longitudinal data from the panel study of income dynamics proves this definitively. Delaying homeownership entry after age 30 is associated with meaningfully lower net worth growth by midlife, even when you strictly control for income and education.
And this is exactly where all the pieces finally lock together. We are witnessing housing wealth rapidly become a launching pad for hereditary privilege. Research from the Federal Reserve shows that parental financial transfers explain about 13 percentage points of the homeownership rate among young households. That means roughly 27% of a young person's ability to even own a home today came directly from their parents. Homeowners are 1.3 times more likely than renters to anticipate leaving assets to the next generation. It creates a stark, undeniable divide. If your parents bought a home early, their compounded equity literally becomes your down payment. If they didn't, you start from absolute zero in a market that demands a $126,000 income and a massive cash barrier just to step through the front door.
The baby boomer generation currently holds more than half the nation's wealth. As that massive, unprecedented pool of capital begins to move to the next generation, we must face a sharp, undeniable conclusion. As the Urban Institute so chillingly notes, the great wealth transfer will likely be a transfer of inequality. The historical advantages of homeowners, the massive tax breaks, the forced leverage, the decades of compounding equity are being codified into bloodlines. The legacy of who got to buy a house 30 years ago is dictating who gets to buy a house tomorrow. The rest of the nation is being systematically left behind in a state of perpetual, equityless occupancy.
So I want to leave you with this. What happens to a society when shelter becomes an exclusive, hereditary asset? When the greatest engine for social mobility in modern history is pulled up like a drawbridge, leaving the majority of people simply paying off the mortgages of the minority. The structural truth about money and housing in America is that the game has fundamentally changed. And the worst part, most people will never realize it until they've spent a lifetime paying for a dream they were never allowed to own. Thank you for joining me for this explainer. If this changed how you view the market, please subscribe to USA Rift, like this explainer, and comment your thoughts below. We read every single one. And to support more deep dives into the real numbers behind the economy, consider becoming a channel member. Until next time, keep looking beyond the surface.